Okay. A few more people joining, so as and when. Like I said, hope everyone's well. First one of 2025. We do these bi-monthly, but there's so much going on. I'm pretty sure we could do one weekly at the moment. But look, Matt, we're 2 minutes into 60, so I'll let you crack on, mate. Like I said, keep on firing the questions, guys. We're happy to answer them all at the end.
Yeah, cheers. Thanks, Matt. Yeah. As Matt said, if you have any questions, please type them into the Q&A and we'll try and get to them before the end. If we don't, we can follow up with an email afterwards. But yes, thanks very much for joining us again. It's been obviously a busy start to the year, so there's plenty to get through. We're going to focus mainly on sanctions, tariffs, potential sanctions, and as much of an overview of the different segments as possible. But in the interest of time, we're going to sort of focus on those topics primarily. So where are we? Where are we sort of in the market, so to speak? For anyone who was with us in December, it was a pretty low point for the markets, and we are definitely moving past that. Some markets are doing better than others, but we're definitely seeing a pickup in January and into February. But the gains have been relatively modest. An increase in exports has been one of the main drivers. However, sanctions, geopolitical uncertainty have overridden that and actually having a larger impact on rates than the growth in exports. We've seen an increase in crude on water and oil and refined products on water compared with December levels. However, it hasn't it's not been significant. So there's other things at play there. So let's get into the sort of oil side, the actual flow side, like what's driving the market here. So as you can see, crude, chart on the left, both crude and refined products, the declines that we saw over the second half of 24 have slowed. With the crude and DPP on the dirty side, there's some volatility, but fundamentally, we're moving back into a more towards an increase. For refined products, we've seen big increases. Obviously, in October, November, we saw that huge drop in terms of clean products from the Middle East to Europe that really hit demand, primarily on the LRs. That bounced back. However, we're going to continue to see a lot of volatility there, but fundamentally more clean products being shipped. And again, the chart on the right is one I've discussed before at length, which is just focusing on crude exports by region, so west of Suez and east of Suez. So the main story over the second half of last year was that huge decline in long haul flows from the west of Suez, and that has increased to an extent, but a lot of that is sort of remaining within the west of Suez. So yes, west of Suez crude exports have picked up. There's been a bit of an increase, but it is still sort of some way off where it was earlier in 24, late 2023. And so those longer voyages, the absence of them has meant that the start of the year is maybe not as strong as it would otherwise have been. And the market, this was one of the points that we highlighted in basically over the prior sort of 6 months, which until we see a return of those longer voyages, particularly for the Vs, then the market is going to remain somewhat subdued. So moving on to the dirty segment specifically, so getting into it, so focusing on the ton miles on the left, you can see that stabilization of flows has resulted in a more of a stabilization in terms of ton miles. The red line there has improved somewhat. The year-on-year change looks very negative because obviously this time last year we were seeing huge increases in ton miles across almost all segments, but mainly for VLCCs and Suezmaxes. Now, on a monthly basis, Aframaxes and Suezmaxes have actually struggled in January, whereas the Vs are the ones where we're seeing some of that increase. And you can see that in the chart on the right, which is productivity, where the VLCCs are sort of hovering around current levels, but we're actually seeing a decline in Suezmax and Aframaxes. So, if we were to strip out the sanctions impact and those sort of concerns around Russian supply and Russian freight, then actually I think we would actually still be in a relatively soft position market-wise. We'll come on to the situation with the Red Sea a little bit later. And then the chart in the middle is just to sort of highlight how Q4 was versus Q4 2023. A little bit has changed, but not significantly. Fundamentally, you can see the big losses in terms of Brazilian and US crude exports, was one of the main is one of the main problems that the dirty tanker market has. And then in the east of Suez, from the Middle East, obviously big growth in ton miles from Iraq because of the longer voyages around the Cape to Europe. That Saudi segment has actually been declining, has been getting smaller and smaller. And by that, I mean, we're seeing an increase in Saudi volumes that is lifting ton miles steadily. It was still down compared with a year ago. However, over the course, the second half of last year and moving into this year, we're seeing greater ton miles out of the Mideast Gulf. And that has been, one of the bigger, one of the stronger sort of segments there. Now, in terms of the rest of the year, we're going to come on to a bunch of the other different drivers that are affecting the market. But focusing while we're looking at the VLCCs and the crude market, just a reminder of our view on OPEC, non-OPEC supply. So, we're expecting supply growth of around 650 to 700,000 barrels a day. And almost all of that is going to be non-OPEC, which doesn't really leave much space for OPEC. So we're sort of maintaining our view that a delay of cuts is sort of the natural option as we're approaching the next deadline. But yeah, Matt, I'm glad you came back now, because I wanted to get your take on that. What's your view around the whole OPEC story?
I mean, this is where I've got to exercise tact, which isn't a strong point of mine. But no, just on the OPEC situation. So we've recently hired, I'm not sure people know, we recently hired probably the most respected OPEC commentator in the market, Amina Bakr. She joined us from Energy Intelligence. So she's now with us. We're now a secondary source to OPEC, which started early February, around the same time Amina started. But look, I mean, our view on OPEC, as we mentioned last year, do we see them bringing back oil this year in 2025? Probably not. And I think the market has kind of priced that in. Is the market still fragile? Seasonality is going to pick up. Look, there's a few things against that. I think rather than concentrating on, discipline when it comes to cuts and adhering to the cuts and compliance, I think it's what other sources do. We published a report this week about, we see an excess of WTI coming into the summer. Is that going to affect differentials in the Atlantic Basin? Is that going to have an opinion? Is that going to, form an opinion on OPEC perhaps they didn't have before? What does that do for Brent TI? There's lots to take in, but essentially when you boil it down, it kind of, OPEC are landing, I think, where the market is, which is a fairly benign background. We're fairly range bound on Brent just from a pricing point of view. But look, like you said, I know you're going to touch on it all later. I think OPEC are sitting back and watching, and it's all about what Donald does. It's all about what happens to tariffs, what happens to the Red Sea. I know you're going to touch on all this, Matty, but OPEC, wait and see, I think, is the policy. Yeah,
I agree. And I think the other sort of uncertainty is Iran, exactly, related to Trump, and we will touch on this again in a bit. But while we're talking about OPEC, if we do see big export declines from Iran, that does give the other members of OPEC that do have to comply with quotas a bit more wiggle room to sort of increase within the wider OPEC system, OPEC plus system, that would potentially see some increase from there. But yeah,
you're right. And look, just on that, I mean, we heard earlier on this week that Iraq are saying that the pipeline to Ceyhan should open up. We wrote an article on the back of it almost immediately. I think Homayun, our sort of head crude analyst, had it ready. We actually don't see that happening. It's just too much too soon. Too much is owed. There's a lot under the bridge there. This is essentially going to bring back around 160,000 barrels a day of crude into the Med, so it affects S&D balances. But it may be the sort of offset that, with Iran going, not being able to export as much, perhaps that's the offset there. But look, again, it's this adding to this wait and see argument, right?
Yeah, absolutely. Yeah, so before I move on to sort of onto the clean side, I think just to, dive into some of the other segments a little bit. So as I mentioned, sort of the VLCCs, but the Suezmax and Aframaxes, we've had this decline in productivity, which is primarily down to a decline in ton miles rather than, an outrageous increase in vessel supply, which has been, deliveries, as we know, have been pretty modest. The there are some stronger demand sides. We've seen in the last Tankers Monthly that I published in January, I highlighted how, as of January, we had a record number, record share of Suezmaxes operating in the west of Suez. It was the highest it's ever been. And a lot of the factors there are seasonal. So for example, with Guyana, we had, production increases that have allowed an increase in exports. And between November and January, all of that went on Suezmaxes. So we had a record ton miles there. From this month, we've now got VLCCs coming back in the game. As those winter sort of weather restrictions are loosened and VLCCs can start loading again from those FPSOs, that is going to start to eat into the Suezmax demand again. Suezmaxes, also suffered because, and I'll come on to the competition with the clean segment, but, a lot of Suezmaxes came back from trading clean. And, that meant that supply, we had about, 30 return. So that would have increased supply there, which was a factor. And then for the Aframaxes, it's a combination of factors, but essentially demand from Russia has been flat. And then we saw a big loss in terms of flows from the US, which really hit the TD25. That is going to continue to struggle because we have so many Suezmaxes operating in the west of Suez. But we'll come on to some of more of those factors in a bit. So moving on.
I just want to add one thing to the OPEC stats. Just while I look on that middle chart on crude, I think the other wait and see as well that we've got to discuss, that OPEC are probably discussing, is quite when Dangote gets to full capacity. That is one of the biggest shifters in Atlantic Basin crudes. Of course, they've got skin in the game, fair as well. They've done extraordinarily well. They're sort of halfway through in terms of production. There are a few issues at the moment, which I think were planned maintenance, but they being Dangote, Aliko Dangote as well, said that within a month they should be up to the nameplate 650,000 barrels a day. That takes a Suez market out of the market per day. So that's another one to look at. And just the orange line there, Guyana. One of the big things we said, we touched on it in December, Matt, was it's OPEC are looking at non-OPEC supply when that plateaus. We see that kind of Q4. So it's one we're keeping an eye on. But I think Dangote is going to be a real sort of mover for what happens in Suezmax freight, especially. Yeah,
absolutely. And I think the growth in the west of Suez, but one of the things we talked about in December was the fact that the growth in non-OPEC supply was going to push down west of Suez differentials relative to the Mid East, make them more competitive. We're not necessarily seeing those flows as much as we were. Part of the reason is Chinese crude imports, Chinese buying has been relatively low this year, despite the fact that actually refinery runs have been pretty firm. So they have been drawing down on stocks. At some point, they're going to have to replenish those stocks. So which, will be pulling in, maybe not US because of the retaliatory sanctions. I mean, not sanctions, tariffs, but other west of Suez grades will benefit from that. Which is only going to be good for those Vs. And again, we're back to a case, as I've discussed before, the Vs are now sort of driving the market. So we do need to have a stronger VLCC market before we're going to see any improvements anywhere else. So on the clean side, it was an incredibly volatile end to last year where we started to lose a lot of demand from the clean segment. And then for anyone who's been on these calls before, I won't dwell on it too much, but essentially this light green section other is Suezmaxes and VLCCs. So essentially those vessels started moving in on those segment and really started to eat into clean tanker demand. And then it dropped even further in November when we fundamentally saw a massive drop off, both because for seasonal reasons, but also from arbitrage reasons, where a real decline in jet and gas oil from the Middle East Gulf and India to Europe. That has bounced back to an extent. We're seeing increased flows there. And I'll come on to, I actually have a chart later which discusses the dynamics between the LRs and the Suezmaxes in the Middle East Gulf and what's happening and what's likely to happen there this year. But, chart on the right really shows that, that fundamentally the LRs, the productivity of that fleet is still way above where it was previously. So the fact that rates have declined so much shows that that's sort of been normalized as a new level, which is a bit of a concern around the potential for a effective reopening of flows via the Suez Canal. And for MRs are in for a bit of a tricky year. There is not a lot of good demand side stories. At the moment, rates are sort of being supported by a supply reshuffling. And again, I'll come on to the fact that we've seen a huge net shift in terms of tonnage from the west of Suez to the east of Suez, which is supporting west of Suez rates, but is really sort of putting the boot on top of those rates in Asia. So let's talk about the Suez Canal. So it's been about a month since the Houthis announced that they would cease attacks on vessels, non-Israeli vessels transiting the Suez Canal, which was essentially opening the door to a return to commercial trade through the Suez Canal. As of now, we have not seen any significant change in terms of tanker transits. So the chart there on the left shows that. You can see there's a lot of volatility, but fundamentally we are still order of magnitude below where we were prior to the outbreak of the attacks at the end of 2023. This is something that the fact that the ceasefire is holding, the fact that the longer that goes on, there is more chance this will happen. However, it's coming from not a position of negotiating strength from an owner's point of view. They have to take the Houthis at their word, and that will make a lot of owners very, very nervous. But the longer that this persists, the more chance there is that we will start to see more vessels. Yeah, Matt.
Yeah, look, I mean, I don't want to put any hyperbole around this, but to me, this is humble me. This is the biggest disruptor in freight this year, in terms of in the clean market especially. And I tell you, it's quite an interesting sort of move. Next week, IP week, obviously, or IE week, and it's the first time ever in the 25 years that I've been attending IP week, I've known an insurance broker host a party. And I know that come up, well, why is that relevant? But it is relevant because people are talking to the insurance market so much more. And I think next week there will be questions to any underwriter or broker about, okay, when are you going to adapt your policies? When is war risk premium going to come out of the market? How much longer do you think and I'm asking this to you, mate, how much longer do you think underwriters or the insurance market in general and the reinsurance market, whatever it may be, need to see the ceasefire hold before they start these charterers liability or cargo insurance policies before they start? I know that's a big question, right? And that's probably one a lot of people. And don't forget to get your questions in on the Q&A at the bottom. But having some tanker owner friends, they're waiting for the insurance market, right? Is that how you see it as well?
Yeah, 100%. And I think in terms of how long it takes, I have no idea. And I would almost argue it's not even about time. It's about maybe they need to see more. Maybe they need the fact that the international market has no control over that seaway is a massive concern. Is a massive foreign policy failure from the Biden government last year that happened and has been allowed to persist. And it was a real reminder that the free transit of the global oceans is not taken for granted, right? And was essentially backed by the US, and we all sort of took it for granted. I totally agree, though. This is it's an insurance question, 100%. Until the premiums come down relative to freight, or until a lot of charterers are willing to offer higher freight already. A lot of owners are pushing back and saying it's not worth it at the moment. We don't want to risk it at the moment.
I mean, it's such a big, because the market, I would argue now, is patterns move. Jeff Goldblum in Jurassic Park, he said, oil will find a way. It always finds a way, just patterns shift, right? So, you think about the sort of infrastructure that's had to move, Egypt, just going to Egypt, GDP being affected because Suez Canal transit fees are down. The Red Sea refiners, your Yambus, etc., not able to go south. And then you've got your Dukums, which have passed the Bab and Badeb Strait, who have really benefited and be able to supply that East Africa short. So it's such a sort of one thing I would say, and of course I'm going to plug Kpler here because I'm allowed to. It's our webinar. But no, in all seriousness, when you look on the map on the terminal, on the Kpler terminal, and you go to all the boats that transiting through Bab and Badeb, a year ago, all of them would have said armed guards on board, Russian cargo heading for India. I'm looking now, and I reckon 1 in 10 says that. So I think that I don't think the market is becoming complacent that the ceasefire is holding, but I think I can see it happen. I don't think it's going to happen until I think it needs to see what's happening in Saudi right now when Trump and Rubio go and see them. Politics, Trump again. We've already mentioned him a few times, but it's I think it's soon that we see this, and I think, like I said, next Wednesday IP week, I'll be really interested to sort of read the room in that insurance broker party that is being had, first one ever. I've known an insurance broker getting involved in IE week like that, because it's just it's the difference between making money and losing money on an arbitrage. So another wait and see moment,
yeah,
Matty,
absolutely.
I think. Yeah.
Yeah. No, I totally agree. And I think the chart on the right, I've shown this before, so I don't want to go over it too, but just as a reminder of how significant that the change in flows was for jet and diesel. We saw 34% increase in ton miles and what was it, about a 13% increase for diesel. Huge increases last year that really sort of propelled the clean tanker market higher. Those will collapse back down. The gasoline is a separate story. That's an MR story, which I'll come on to. The problem, they've got their own problems. But yeah, if we were to see transit reopen, then it really would hit demand quite significantly. So let's turning to focus on the sanctions, specifically the US Department of Treasury sanctions on the 10th of January. What they've done to the market and how the market has adapted in the month and 10 days since then. So some stats: the ships that were sanctioned accounted for 25% of Russian crude export ton miles last year. This was not distributed evenly. 61% of the ships that carried ESPO last year were sanctioned, versus just 19% of the ships that carried Urals last year. So I'm going to explain that in a little bit more detail. Essentially, Urals is by far and away the biggest crude export grade. Accounts, you can see the chart on the right in terms of compared to the others. And the next is ESPO. So these are the ones that we're most interested in. So the fact that so few of the, only 19% of those ships that carried ESPO last year compared with 61, that is going to have repercussions. Now, the reason that happened is because ESPO is fundamentally a higher value grade, and I would imagine the US Treasury had more evidence of evidence that those vessels were infringing the price cap. It was easier to prove that when a grade is trading well above $60 a barrel compared with Urals. So that's probably why that has happened. Now, what this means is fundamentally Russian crude is not massively affected. Urals, that bulk grade, is able to continue moving. It's lost 19% of the ships. I say lost, we'll come on to that. But 19 to 20% have been sanctioned. That still leaves a lot that you can increase utilization on and keep those flows moving. Now, for ESPO, it's a slightly different matter. And as a result, we saw a difference in the impact on freight. I can actually start with a chart on the right. So the dark blue line is the ESPO freight, and that jumped 500%. Whereas for Urals, I've taken here Black Sea to West Coast India, that jumped, but the increase was relatively modest. These were proportional to the requirement to pull in more vessels, to increase the supply of vessels to maintain those flows. Again, doesn't mean we haven't actually seen any significant impact on Russian exports in the aggregate. However, to maintain it, we're having to see a shift. Now, just to sort of highlight, for non-Russian freight, we did see an initial jump, particularly for VLCCs. That was not related to plugging the gap. Obviously, VLCCs are not used much from Russia. This was China and other countries looking to sort of concerned about supply availability, sourcing other barrels, and as a result, they've dropped back down. Aframaxes in the Med, that was a bit more of a relationship where an increase in demand for vessels for Russian trade, that increase in rates has pulled vessels that also trade in other markets, and that is significant. So again, a bit to unpack on all of these. So what we're looking at here is that on the charts on either side, Eastern Russian crude and Western Russian crude, just to sort of differentiate them. So the total is the orange line, and then the blue line is the volume shipped on the ships that were sanctioned on January 10th. So you can see for ESPO, for the Eastern Russian crude, they accounted for the bulk of it. As you said, it was like, 60% of those ships. That has dropped down significantly. It's not quite zero. Some of them are still active, but it has dropped down. And then for Urals and other Western Russian grades, the impact has been much smaller. And you can see that, although, it has declined. So there is an increase, there is a necessity to find more vessels. It is less severe. So what I've done is I've gone into this in a bit more detail to find out how it's being. So of the vessels that were not sanctioned, so of all the ships that have traded Russian crude since January 10th, the ones that are not sanctioned, there has been a significant increase in their utilization, both in the West and in the East. So starting with the East, you can see, so this chart just shows exports in KBD on the vessels since January 10th that were not sanctioned. And you can see previously they would trade other things as well, other cargoes. Now it's almost exclusively Russia, and it's the same in the East with Urals. Now, there's been a lot report of like dozens of ships, new ships that are brand new to the Russian market being pulled in. There is some evidence of this. However, the main factor taking place here is the vessels that were previously trading Russian also traded other cargoes. In previous presentations, I've shown that in total, when you look at all vessels that trade Russian cargoes, on average, their Russian demand accounts for about 65% of their business. So that leaves a good segment of the market where they're doing other markets, and this is quite diverse, a lot of Middle East cargoes as well. So essentially what these sanctions have done is these ships have said, those rates in Russia are particularly good. I'm going to drop all of my non-Russian business and focus predominantly on this Russian business for the time being. And that has an impact. And the chart in the middle is so related to these ships. So what I looked at is how many of those ships that since January 10th that are non-sanctioned, what were they doing in the 3 months prior to sanctions? 12 of them were trading in Western Russia. So 12 of these ships have moved from the west of Suez to east of Suez to solve the ESPO vessel supply problem. The rest were either ESPO, some were Iranian, and actually only one of them in this case, I found had no history of trading Russian business in the last 4 years. So a lot of them may have done relatively little Russian business and they've just increased it. So some might do one Russian cargo a year. Now they've done 3 ESPO loads in the last couple of months. So that has been the main shift. It's a massive increase that they're working harder and they've dropped all their other business. And that's the main takeaway there at the moment. Now, what does that mean for the non-Russian market? What this means is this segment here of other that is disappearing has to be filled elsewhere. So that is going to be supportive of non-Russian freight rates, particularly in the west of Suez, where we're seeing, we've already seen 12 tankers make that move east to plug that gap. So this will over time begin to sort of support reduce. It's been a reduction in supply for Med, cross Med, North, even US Gulf, anywhere you've got Aframaxes and Suezmaxes that are trading, there's going to be fewer in the market, which is going to be supportive of rates. Turning to sort of sanctions more broadly and Iran. So our expectations are, that Trump will impose more sanctions on Iran this year. We don't quite know what shape they're going to take, but they could be, similar to what we saw on January 10th, where it was a huge number of vessels sanctioned in one go. That would have less of an impact on those ships than it did for Russia. And the reason is we've seen over time is fundamentally, this chart on the left is exports of all of the vessels sanctioned that we have under our risk and compliance tab on the platform. So, it requires a little bit of clarity because I downloaded this yesterday. So as of yesterday, this is where the situation. Now, bear in mind, all of these vessels have been sanctioned at different times over history. So just because what this isn't saying is February 23rd, these vessels were ignoring sanctions. What it means is since then, more have been sanctioned. So you can see the sanctions have an impact. These vessels are doing less, but it's mainly Russian. It's actually had a relatively small impact in terms of Iranian exports. But this is probably set to change. Over time, we are starting to see that particularly OFAC sanctions are more effective on vessels related to Iran than other sanctioned entities, OFSI, UN, EU, etc. And what this has meant is the chart on the right highlights this, and I showed this in December as well. I just updated it to show that the gap is still there, which is the blue line is the supply of vessels that service Iran. And then the blue line is the ton miles. And you can see we have a bit of a big gap at the moment. So there are more and more vessels moving into this market relative to the demand. So their utilization is going down. Their productivity is going down. We are forecasting 500,000 barrels a day of production decline from Iran this year. That is only going to see this drop further. This is not going to go anywhere. These vessels can't now return. A lot of them there's no option for them to return to a commercial market. They're too old, or their history is just too spotty. And so that opens the door for scrapping. And we made this point in December, and we're still holding the line on this, which is this: if we do have greater sanctions imposed on Iran, we will see more cargo fundamentally shifted from other Middle East countries onto, which is very beneficial for the commercial tanker owner. And it means that we have an increased number of idled vessels who are doing very, very little work. The utilization of them is already dramatically lower than the commercial fleet, and it will only fall further if we see Iranian ton miles drop further. So this is, while sanctions have had a limit, on a vessel by vessel basis, have not necessarily seen them removed from the fleet, we are going to see the amount of business each vessel is going to get is going to fall further and further, and at some point, some of them are going to call it quits and leave the market. So,
mate, can I just hi, mate. Look, I know we're saving questions to the end, but just something that's a few people have asked me today. There's this speculation out in the market that certain tankers that are carrying Russian goods have been attacked, like singled out in the last few days. There was one, I think we saw one last week. It was on marine traffic that was sunk up in Primorsk or Luga. There was one yesterday, I think, a Thenamara ship. Look, I suppose it's not an outright question, just more an observation. And we're speculating here. No one knows. I think the sort of path to the attacks are unclear right now.
Yeah.
But I mean, again, I suppose we'll cover it at the end. But the longer that these peace talks apparently go on, if Ukraine do come around the table, is that going to have a dramatic effect on tankers that are going to, like these ones you're saying that are not part of the dark fleet? These tankers are moving stuff that's under the price cap, because Russian oil isn't sanctioned. It's just certain countries can't import it, and you've got to do it under the price cap. But I don't know. Do you think there's any? And I'm putting you I'm throwing you under the bus here a little bit. Do you think there's any meat to that bone on these tankers being attacked, or is it just sort of random at the moment?
So the thing with the Thenamara is very, very strange, and I think we don't really know what's going on there. But it's concerning, and it part of this broader pattern at the moment of incredibly opaque vessel movements and vessel behavior, and but not accusing Thenamara of anything at all, but like they could be the victim of something. But there's a lot of very odd behavior going on in the market. Yeah. But in terms of that, in terms of the potential for a peace deal between Russia and Ukraine, I think the question really resolves around what does the EU, what does Europe decide to do? Because the US is a separate, the US, in terms of the oil market, like they have a relatively small impact in terms of flows. It's Europe. If Europe decides to start taking it in again, it's potential that it's, we've seen stranger things happen, but I would be surprised if the EU were to change so quickly
Yeah, I agree.
against that. And as a result, flows would likely remain the way they are for the time
Okay,
being.
look, let's there's a few questions that are coming in around this very subject. So let's keep on piling through, mate. It's really good. And then
Yeah,
we'll sort of raise as a separate topic. And if people got more
yeah.
questions on what's being attacked and when flows will come in, then
Yeah,
let us
yeah.
know.
So,
We'll pick that up
so
at the
now
end, mate.
we're moving into the territory of definite unknowns, but we've got to discuss them because they're big topics. So, starting with Trump tariffs, I say Trump, U.S. tariffs on Canada and Mexico, which have been paused until March 3rd, I believe. So, if when we come to March 3rd, it is confirmed that they're going to be imposed, let's start with Canada. So I'm going to focus really on the freight impact. Now, my colleagues on the crude and product side have published numerous articles on that because there's a very, very big impact that is non-seaborne, particularly to do with Canadian barrels via pipeline into PAD 2. I'm going to sort of park that because it's not a shipping story. But focusing on the freight, and our base case is for a limited impact. And the reason is it's at the moment, we think it's more likely that Canadian producers will reduce prices by a couple of barrels in order to keep those cargoes going into PAD 5. So at the moment, you can see ton miles, vast majority of ton miles are into Asia just because of the longer voyage. But actually, in terms of exports, it's closer to 50-50 in terms of TMX going into PAD 5 and Asia. But let's just imagine a situation in which all of those barrels go to Asia by, say, April, just hypothetically. That would increase ton miles by about 90% with about a 20% increase in vessels. And the reason that's lower is because we would be shifting from a lot of Aframaxes onto some more VLs. Now, there are Aframaxes doing Vancouver to China, but we would likely see a proportional increase in VLCCs as well. So there's not going to be as big a jump there, but it would be very supportive of freight in that area and would require more vessels in the area to service that. On the product side, but again, just to reiterate, the base case is we actually see we don't expect to see exports to PAD 5 drop to zero. On the product side, it's a bit more complicated. So the product impact is entirely related to Canadian product exports, almost entirely from the Irving refinery on the northeast down to the US East Coast, where this is essentially the whole of the refinery output. The main product issue here is gasoline. As you know, US is net short, and so they would need to source that elsewhere. In reality, that becomes an issue, particularly if the US also imposes sanctions, not sanctions, keep saying sanctions, tariffs on Europe. So the Europe's alternative supply, but it takes gasoline from a number of places, but Canada and Europe are some of the main sources. So fundamentally, if they tariff both countries, they just got to pay more. The end user is paying more for gasoline, and it would lift the price. So we are not necessarily expecting to see big changes here from a freight point of view. I think one way or another, the barrels get shuffled around, but it might just be that they continue the way they're going, and just the average American is just paying a little bit more there. Mexico. So Mexico, we do expect that if those tariffs are imposed, we would see an increase in freight demand. And the reason here is, so Mexican crude into PAD 3 has been in decline. However, it's still, you can see here, it's under this North America line. It's about 4,000 barrels a day recently, but it has been in decline. Still, sizable amount, and it's a very short haul voyage. So those barrels are going to go elsewhere. We expect most of it to go to Northwest Europe on Aframaxes and Suezmaxes, so supporting both those vessel sizes. And the US needs to replace those grades. A lot will be from Latin America, but also potentially some from Middle East, just based on a crude slate point of view. So we expect around a 20 to 30% increase in ton miles through the redirection of Mexican grades and the increase imports, the redirection of imports there. Now the product freight. So unlike Canada, where the US is Canadian exports to the US are very important. Mexico doesn't really have anything it can do in response to these tariffs. They just have to sort of take them on the oil side. They are reliant on US clean products, particularly gas oil. They can take gasoline from the US, from Europe and elsewhere. But for the gas oil, unless they take it all the way from the Middle East or somewhere else, they don't really have much of an option. So that could, we're not really expecting to see any change there. We think those flows will just continue one way or the other. Yeah, but please, get your questions in if you have any thoughts on those. And we're coming towards the end, and so I hopefully leave enough time for the questions I can see that have come in. So just to sort of focus now in on a couple of those key segments on what's been happening. So one thing we've talked about in the past was this change in the dynamic in terms of VLCCs in the Atlantic. And at the end of last year, we were going through the decline, and this was entirely related to the fact that we have seen this slump in west of Suez VLCC crude flows to Asia Pacific. Now, this has continued, and yet we are seeing an increase in the fleet in the West. A lot of that is because fundamentally, despite this, US Gulf or west of Suez VLCC earnings were at a premium or tended to be at a premium to the Mideast Gulf. This is actually in the last week flipped back, and actually now the Mideast Gulf is earnings are at a premium, but fundamentally we're still seeing some here. We're seeing this increase here, which has been part of the reason that we've seen that pressurization on VLCC earnings, considering we're not seeing a big increase going east. A lot of that is Chinese buying is below where you would expect it to be, considering refinery runs. There's been a big gap that one of my colleagues wrote about in a report last week. That needs to be plugged at some point. We would need to see an increase in buying to increase stocks because they have been drawn down. However, we are also soon butting up against spring refinery maintenance, and those Chinese refiners appear to be going into it at a relatively normal level. So that will support crude buying over the next 4 or 5 months, which is why I still, we'll come to the end. I'm still bullish VLCC rates relative where we are for a number of reasons. But Chinese buying, while it's not going to be as growth is nowhere near going to be as strong as what we've seen over, in 23 previously, but there are new refineries, and there is going to be a pull on, particularly on west of Suez barrels. So this is something I mentioned earlier, which is the dynamic between LR2 rates and Suezmaxes. So just as a reminder, this was that huge increase we saw in clean products exported on Suezmaxes last year, dropped away over Q4, a little bit of fluctuations, and then in December hit a low. And I concluded, rightly or wrongly, there we go, that was over. However, the threat was always present, particularly as long as the Red Sea remains closed. That is an incredibly long voyage from the Mideast Gulf and India to Europe. This was entirely a diesel flow on that route. Almost all of that occurred there. Now, what happened here in January was, so the blue line here is the spread between LR2 earnings and Suezmax earnings, and you can see towards the end of January, it dropped close to zero, around zero, as the number of Suezmaxes trading clean was dropping lower. However, at this point, some Suezmaxes that were already cleaned up or were just maybe waiting for cargoes or were ready to switched back and started trading again. And this effectively is going to act as a cap on LR2 rates for the time being. Essentially, if the Suezmax market is doing very, very well, LR2 rates can rise and do very, very well. But this fluctuation is going to continue, and will keep LR2 rates sort of constrained for the time being. And then finally, we've not really spoken about MRs much, but I sort of addressed the fact that the weakness in gasoline growth this year is going to be gasoline demand growth is going to be an issue. But the main story at the end of last year, we saw TC2 rates from Northwest Europe hit a 3-year low. They have subsequently improved, and a big reason for that is this shift here. The number of MRs operating in the east of Suez has shot up, and obviously we've lost a lot. In fact, for the first time in 3 years, 2 or 3 years, there's now more MRs in the east of Suez than there are in the west since January 2023. So this is a significant development, and essentially that has resulted in this, where we have Atlantic Basin earnings at a premium to Pacific, despite the fact that the Pacific is really where the demand growth is going to take place this year. So that supply is looking out for that growth in exports. And part of the reason that we have this weakness is, one, over the January, February, we've had US Gulf refinery maintenance. So we lost about 1 million barrels a day in terms of clean product exports from the Gulf. And then in Europe, exports in general have been steady, but with declining demand from West Africa, Latin America, we've seen an increased share in European gasoline staying within Europe. So those ton miles are shorter. The vessels return to loading points much quicker than they have done previously. And there's nothing going to change there. We're going to see increasing declines in Northwest Europe exports to West Africa this year. So really, really turning the screws on MRs who are already eating into handy business in the Mediterranean. There's a lot of competition going on there. So it's a really tricky story for the MRs this year. They're going to be trying to sort of pick up other cargoes. You're going to be trying to move into the LR1 market in some areas. But really, almost all of that demand growth is going to be taking place in Asia. US Gulf comes back from maintenance next month, which will support the market in the West to an extent. So we should see a slowdown in this movement. But I doubt we will see a big switchback in the near term. And then finally, just to conclude in terms of our outlook. So fundamentally, we are expecting an increase in Chinese imports in the coming month. We expect vessel supply to be tighter as more vessels are pulled into that Russian trade, which should support rates and increase scrapping, particularly on the Vs. And in the clean, a weak MR market is likely to persist in the West. LR rates will be capped, and the Red Sea fundamentally remains a threat, mainly to clean market, but more broadly in general. I won't read out all of these, but as always, we'll make sure these get sent out and they'll be available on the platform in the next 24 hours or so. Thank you very much. Matt, let's get some.
Well done, mate. Well, that's a lot. Okay. Look, as Matt said, the slide deck will be available to those who want it. We've got a few questions that are in. We'll put Matty on the spot. There's no room to breathe here, mate. So be prepared, as you always are. Look, big takeaways are obviously what everyone's going to be thinking about. Russia coming back into the market. Let's say, and look, in a utopian world, we don't live in one of those, trust me. There's no way that let's say the price, there's a ceasefire, Russia, Ukraine, it holds, the price cap is abolished and Russian oil is allowed to flow again. Essentially, you can say, okay, there's more cargo coming into the market. They'll have to manage it with OPEC. That's bearish for flat price, bullish for freight because there's more cargoes. But again, what happens to these patterns? I can't imagine the EU as a bloc, and especially probably the most bureaucratic bloc there is, suddenly sort of saying, yeah, come on, we'll have some of your delicious gas oil again. I can't see that. So
yeah,
in a hypothetical world, then if you do see the price cap lifted and Trump is able to sort of ceasefire out, does Russian oil flow to the places it did pre-invasion?
So I'm definitely stepping outside of my tanker remit, but what are the arguments for the EU sort of going along with a lifting of sanctions and ignoring and removing the price cap? I think European countries are probably pretty tired with the energy price inflation that we've had over the last couple of years, and I think there'll be segments of the market that will be really ready to start buying some cheaper gas oil, some cheaper crude, and gas. Right, fundamentally.
That's the kicker. It's the gas. It's the kicker.
That's the gas. Yeah, that's the key one. So there is a potential. However, I don't think and I'm really reaching beyond my area of capability. I just don't think the European market is likely to do that yet. I think sentiment in Europe is quite different maybe to the Trump administration in that sense. So I think flows are likely to remain the way they are. And fundamentally, from a tanker owner point of view, that would be very bearish freight. If we were to return to previous flows, the market has really, and I've said this before, has baked in the Red Sea disruption. It's baked in the Russia-Ukraine war, and it's baking in all of these other, factors around sanctions. And rates are not through the roof. They are higher than 2021 levels, but we're not. It's not astronomical by any means. And we would see some pretty steep declines.
And if the sanctions, price caps so oil can flow, oil can move, sanctions are lifted on the dark fleet, then I mean, what happens there? Does that, like you mentioned about the Iranian fleet earlier? Obviously, that's a 40-year sort of plan that National
Yeah.
Iranian Tanker Company put together. They invested in their own tankers, their own tonnage. Obviously, Russia have always done that, Sovcom fleet, etc., etc., etc. But does that come back onto the market as a tradable ship that is, if sanctions are lifted?
So there's two bits to it there. So you talk about the dark fleet, which are mainly the ones doing like Iranian, Venezuelan. There's no chance they're coming back. They're too old, decrepit. I mean, the only reason they're doing it is because they were rejected from the commercial market in the first place. And the fact is, we're more likely to see increased sanctions on them, if anything. Now, the sort of the shadow fleet, which are the loose definition is a bunch, group of vessels that have been traded or acquired with the purpose of facilitating Russian crude. And, they were basically sold over the last 2 or 3 years. Now, there is some potential for them. They're not all very, very old. Some of them are below 20 years and, have, pretty good service history as far as you can tell. Like we said, Russian crude exports are not sanctioned. It's the price cap. So again, they are not necessarily persona non grata back in the commercial market. And as I said, a lot of these vessels do non-Russian business. Only 65% of them is Russian business. So for some of them, some of them might only do 10% Russian business a year, right? So actually, there is a really big interchange between the Russian and the non-Russian freight market, which is why the increase in freight in one has a direct impact in the other. And, as I think I've said before, Russian crude exports account for about 30% of Aframax demand. So it's incredibly important to that market because of those longer voyages now. They could come back, but in a way they're almost not excluded from the market as it is at the moment. But there is a general shift that the general guide that the shadow fleet is older than the commercial tanker fleet. So some of them might not. Yeah.
Okay, look, I mean, just sticking with Russia because we could probably have a webinar about the implications of Russia, and I'm linking some questions here because we've got quite a few, but keep them coming in if you do want to ask something specific. Market share. Now we were talking about. Let's talk about tariffs, Trump tariffs. Someone's asked a question about Mexico, and I think it's a really, really good question because linked to the change in flows. Could there be a sort of spiteful response from places like Mexico? They may say, okay, well, I won't buy from you anymore. I'm not going to sell my material to you anymore because of these tariffs. That means that, Donald, you wanted cheaper oil prices to make America great again, et cetera, big part of the manifesto. And could Mexico go, okay, well, listen, we're going to go a different route and we're going to buy gas oil from, or whatever they want to buy, from Russia. And I'll use Brazil as an example, right? If you go back to 2022, so February 2022, Brazil bought 16,000 tons of gas oil from Russia. In February 2025, they bought just over 1 million tons because oil has found a way. People adjust, and the Russians are actually being exceptionally dynamic to find markets that perhaps, those markets are always fed by the US Gulf Coast. Could Mexico go that way as well? Could that be, I know Canada are not going to go that way, but historically the places where, where the tariffs are now going to come in, I know Colombia sort of crumbled under the pressure. Mexico is going to be one that people are going to watch. Do you think it could go that way as well? Or is it a bit too risky for them?
To be honest, theoretically, they definitely can. I don't know enough about the Mexican government's stance related to Russia to be able to say if they would, and I think that's what it would come down to fundamentally.
Yeah, because at the moment they're still buying coal and wheat, but I think they haven't bought any oil yet. No oil's come from Russia in looking on the terminal. So I think that's one to watch. It's a good question. It's a good question. We've got another question in, Matt. Why this is maybe a bit much for us? Why did they target the CPC pipeline? I mean, it's not confirmed yet, but I mean, let's speculate, shall we? Why not?
Yeah, let's speculate. I think, so some of those volumes are Russian, very, very small. The vast majority of them are obviously Kazakh. I think it's 95% of the volumes that come out of CPC are Kazakh. Why not? I think the Ukrainian policy has been to disrupt and create disorder. So I think it's all part of that. I think, when it comes to Russia's energy infrastructure, there's an endless number of targets. Not to give anyone ideas, but there's plenty more out there. And I think it's just one of, they've gone after refineries, they've gone after power plants. I think it's just a natural progression of that policy.
Yeah, and there was rumors that it was linked to Russians' military fuel supply. I mean, look, it's they're hitting where it hurts apparently. But I wonder if the ceasefire is agreed and these stop refinery runs pick back up in Russia, what that means for gas oil cracks or naphtha margins, whatever it may be, because naphtha, fuel oil, and gas oil are really going to be the sort of bellwethers on what happens there, because there's a lot of being exported. I got a good question here. Specifically, this is a freight question, not a political one, so don't panic, Maddie. Question: Urals has traditionally been an Aframax market, Black Sea loadings aside, due to the local nature of the market pre-sanctions. If sanctions are removed and Urals remains a long-haul barrel, would you expect an uptick in Suezmax demand to service the Black Sea to India, China flow and Baltic as well?
I think it would be the same, because it's no change. The vessels that are used now to service those routes are the ones that the market has found to be most economically viable. Those cargoes are going through, that's another thing to highlight, that the fact that we've got 13 transits per day down from 20 something per day through the Suez Canal, those 13 transits per day are almost exclusively Russian crude. It's the only cargo that's not really been impacted whatsoever. So the fact that they're maintaining the use of Aframaxes and they are using Suezmaxes, but to a lesser extent, reflects just the economics of the situation. So I think, if anything, if we saw sanctions removed, if we saw sanctions removed, it would be surprising if the barrels would go long haul, because India would be struggling to create the argument for the discounts it's currently enjoying. Russia would probably have other buyers in the market, and Urals would return to sort of previous normal discounts to sort of benchmark crudes. So you'd almost wonder whether how much would continue going long haul under those circumstances, and so it would.
Yeah, I think it's that to me is one, just gonna last couple of questions. That's the one is what really people are gonna watch. It was Indian Energy Week last week, and the minister was there. And he said, we will continue to buy Russian oil, the third biggest importer of oil in the world, roughly. Price sensitive, 1.7 million barrels a day of Russian oil's heading to India right now, down from the highs, which is about 2.1. There's a few refineries heading into maintenance soon as well. But that's what's really going to be important to see is sanction pressure from Trump. China, we've seen, I think Shandong banned certain vessels from calling at the berth if they're on the sanctions list. India, I think we're under pressure to do the same. But it's clear that the agenda as a net importer, India will continue to buy Russian. But look, Matty, it's 7 o'clock. Everyone's ended a great presentation again. Everyone, thanks for all your questions. Keep going, Matty. We'll do another one. March? No, where are we now? April. April will be the next one, right?
Yeah.
Okay. IP Week next week. Hope to see lots of you there. We'll send you the slide deck. But thanks for tuning in. We'll see you soon. Thanks, Maddie.
Cheers. Take care. Bye.